Thank you for watching this preview video at xm.com. We'll be discussing the upcoming U.S. employment report and the potential reaction in the dollar. I'm Maria Bashardis, and joining me is Senior Investment Analyst Harlambos Bisuros. So Harlambos, at the Fed's last meeting, policymakers were pointing to 3 quarter-point rate cuts for 2024. What news have we gotten since then, and what are we likely to get from Friday's employment report for March?
Hello, Maria. Yes, indeed, the Fed appeared more dovish than expected at its latest meeting, which resulted in a rising probability for a first quarter point rate cut to be delivered in June. That probability rose to around 80%. However, this was only a temporary assessment. Last week, Fed Governor Waller said that the committee is in no rush to start lowering interest rates, a view also echoed by Fed Chair Powell on Friday, just after the core PCE index for February, which is the Fed's favorite inflation metric, came in at 2.8% year-on-year, as it was expected. And what's more, on Monday, the ISM manufacturing PMI entered expansionary territory for the first time since September 2022, with the prices charged sub-index rising and corroborating the view that inflation in the US remains stickier than previously thought. So, combined with the upward revision in the Atlanta Fed GDP Now model to 2.8% from 2.3% for the first quarter, those latest developments prompted investors to push back again their rate cut bets, with the probability for a June rate cut dropping to around 65%. Now, the next major event on investors' agenda is Friday's US employment report for March. The unemployment rate is expected to have remained unchanged at 3.9%, and the non-farm payrolls are forecast to have slowed to 205,000 from 275,000. That said, the rebound in the employment sub-index of the ISM manufacturing PMI tilts the risks of the NFPs to the upside. With regards to wages, average hourly earnings are expected to slow somewhat to 4.1% year-on-year from 4.3%. Now, these numbers point to further easing in the labor market, but they are far from suggesting that a rate cut is urgent. After all, another month of above 200,000 jobs is very encouraging for the economy. And in my opinion, a wage growth rate at around 4% is unlikely to help inflation come down faster than previously thought.
So taking all this into consideration, what's the outlook for the dollar? And do you think it will continue to outperform the euro?
In my opinion, if the forecasts are met, the dollar is likely to continue performing well, especially against the euro, as according to money markets, a June quarter point rate cut by the ECB is more than fully priced in. While following recent dovish remarks by a couple of ECB members, there is a nearly 20% chance for an ECB rate cut at the upcoming meeting on April 11. However, from anticipating around 160 basis points at the start of the year, the market is now expecting only 65 basis points from the Fed, which is less than its own forecasts of 75 basis points. In my view, this increases the downside risks to the dollar in case of disappointing data moving forward. In other words, if the jobs data miss their forecasts, we may see a notable pullback in the US dollar.
Harlambos, thanks so much. This was a preview video here at xm.com.